Joining me now is Bill Chappell. He's a managing director at Truist Securities. And Bill, you've identified this gap. Who are some of the winners and the losers here?
Well, what we talked about today, good morning and good afternoon, and thanks for having me, was Procter & Gamble in particular. But the point is, over the past 2 years, everybody was lifted by people spending time at home, around the house, work from home, be it not just household product companies, but food companies that were fairly mediocre for 5 to 10 years prior. And you saw ketchup sales up 40% for the first 3 months of the pandemic. So everybody got that lift, and it made it next to impossible to figure out who the winners and the losers were during the past 2 years. And what we're saying today is now, as we're getting to the new normal, whatever that might be, the trends are visible. You can see who's outperformed, see who really is coming out of the pandemic stronger, whereas every company says they're coming out of the pandemic stronger. There are a few, like Procter & Gamble, that truly are. They were stronger going into it. They were beating and raising. They were streamlining their business. And now coming out of it, we think you can see a separation from other consumer staple stocks as people can see real stripes that they have. Your price target is $175. It's trading around $150 right now. What is it that is setting them apart? It's, for P&G in particular, it's the long journey they've done probably 7-8 years ago when they started. They got rid of 100 underperforming brands, including a big part of their beauty business. They reorganized the whole operation. But the biggest thing that we love about it is they focused on product superiority, where they had a mantra where 70% plus of their products had to be superior than the next competitive set. Think of something like Tide Pods, that much better than not only other pods, but also liquid. And having that technical superiority is what's gotten consumers to not just buy the brand, but buy the enhanced product. And that's part of what our thesis today is. As inflation hits all these companies and they're raising prices, we don't think consumers are going to be willing to give up their pods or give up their enhanced razors or give up their enhanced paper towels. You name it, of what they've done to enhance it just because prices have gone up. And so I think not only can they separate just because of their back end, but also they can weather inflation a lot better than they did in the past.
Well, it's a very interesting point. It certainly speaks to experience in our household. Let's kind of close back to talking about Keurig Dr. Pepper. This is a bit of a different story. You have a hold on it. Tell me what the thought process is there.
I wish I had a complex thesis, but it's fairly simple. You, me, we all worked from home for the past 2 years. And they saw a nice surge of people buying Keurig machines because we were drinking more coffee at home. And now as we go back to work, we're going to drink less at home or less K-Cups. And it's not that that's bad for their business. They just had a 2-year acceleration of Keurig makers in household penetration, of attachment rates, meaning the number of pods you drank per home per day. And that's going to go down and probably worse than I think some of the readers is looking for. And Keurig has always been viewed as Keurig and Dr. Pepper. When everything is going well, it's viewed as a beverage company, Dr. Pepper, and gets a higher multiple. When things in the coffee business aren't going so well, it's viewed as a hybrid beverage and appliance company. And that's our concern as we go back to that hybrid valuation. You see multiple contraction, and it's not quite as exciting as it has been as the past 2 years.